วัสดีค่ะก็ได้เวลาขอต้อนรับนะคะสู่การนำเสนอข้อมูลของบริษัท PSL Shipping ก็จะมีคุณคาริดฮาชิมจะนำเสนอข้อมูลในเรื่องของผลทิศทางของอุตสาหกรรมอัปเดตในเรื่องของอุตสาหกรรมของบริษัทนะคะแล้วก็คุณกุชูวาเดียในเรื่องของตัวเลขผลการดำเนินงานไตรมาส 3แล้วก็ช่วงสุดท้ายในเรื่องของคำถามคำตอบค่ะเชิญคุณคาริดค่ะ
Good afternoon. Sawadee krap. We will make the presentation in two halves. In the first half, we will talk about the industry structure, and in the second half, we'll talk about the financials of the company. So here we've highlighted for you on this chart all the sectors in dry bulk shipping where pressure shipping has an exposure. This is a very long chart of the BDI, and it shows you what's happened to the BDI beginning in 1985 and taking you all the way to the current date. In the yellow box, you've got some highlights which you can focus on at leisure. If you were to analyze the same chart but in annual increments and annual averages, you would see that the low point of the BDI was in 2016, with the index being at 673 points, lower than the last all-time low. Thereafter, the market has increased in a very smooth way. So if you look at the chart of the BDI beginning in January 2016 and moving all the way to the current date, you would notice that every time there is a high, it is higher than the last high, and every time there's a low, it is higher than the last low. So this gives us the feeling that the rate structure, the increasing rate structure is reasonably sustainable. If you were to look at the same thing in the form of quarterly BDIs, average of the quarter, against that compare the amount of ships that are being scrapped, you would see an inverse relationship. For example, if you looked at the first quarter of 2016, you'd see that we had an absolute all-time low for that average. Against that, we had almost 15 million tons of ships being scrapped. And if you look at 2016 as a whole, the index was at 673 points, a new all-time low, and scrapping was at a reasonably good level of almost 30 million tons. As the markets improved in 2017, as you can see clearly the BDI quarter by quarter going up. If you look at the average for the year, it's almost double of what was there in 2016. And similarly, if you look at the amount of ships scrapped, it's half of what was there in 2016. And similarly, you can see that scrapping has almost disappeared during 2018, with the market showing reasonably strong growth. The question then is that, is China's growth sustainable? So if you look at the major data points, you would see that more or less, despite Trump's rhetoric on tariffs and trade, more or less China has done exceedingly well in terms of all the major commodities. Iron ore is mostly similar to last year, but yet there appears to be some growth. If you look at coal, it's a significant improvement over last year in the first 9 months. If you look at steel production, it is up significantly. If you look at steel inventories, they're marginally up compared to last year. Steel exports sharply down. Therefore, you could almost straight away say that based on these last 3 numbers, China is consuming much more steel than they used to. The same thing in graphical format, with the orange bars representing 2018 and the blue bars representing 2017. So just shows you how things have changed. So as far as iron ore is concerned, in the first 9 months, it was down 1.8%. In terms of coal was up 11.4%. If you look at soybeans, more or less stagnant, same as last year, but this is despite such a large portion of soybeans actually normally coming from America. Out of the 95 million tons that was imported last year, almost 33 million tons came from America. And this year, America is down by almost 95%. compared to last year. And despite that, soybeans into China is more or less the same as last year. If you look at steel production, inventory and exports, it's what I told you just now, but all in graphical format. You can see clearly that production has gone up significantly, whilst inventories have more or less remained the same as last year, whilst consumption, or rather exports, have dropped significantly. Therefore, you could say that consumption has gone up significantly in China. These are some facts about China, and from this you would see clearly that there is no correlation between GDP growth numbers in China and iron ore imports or coal imports or steel production or steel exports. So you need to look and drill down from the big number down to the more granular look at dry bulk commodities. Then you would get a better feel as to what's happening in China. Coming to the supply side, in the first 9 months of this year, you can see clearly that 19 million net increase in tonnage has taken place. This is because scrapping has slowed down. And if you were to see what is there still to come, there is another 1% of ships still scheduled for delivery during this last quarter. And if you look at the next 3 years and combine it all together, you could say that roughly about 10% of additional ships are expected in the next 3.5 years. In that, if you were to analyze that, you would see that the majority of the ships coming in the next 3.5 years is all the bigger ships, not the ships that we are involved with. These are the order books that have taken place, or fresh orders that have been taken place each year. And you can see clearly that in the last four years, if you were to look at 15, 16, 17, and 18, you could see that more or less 90-95% of all ships on order are in the gearless or in the large ship sector, and not in the sector that we are presently in. This is a nice chart which shows you that in the first 9 months of this year, or first 10 months of this year, we've had roughly a drop in new building deliveries compared to last year of almost 12 million tons, or 33.5%. And at the same time, we've also had roughly almost 8.8 million tons of less number of ships being scrapped, or 65% reduction in the scrappage rate compared to last year in the first 10 months. But yet, despite that, there is about a 3 million ton less number of net increase in tonnage as compared to last year. If we look at the annual averages and base it on 20% of slippage and take 8 million tons of scrapping, then you would see that 2018 will end with a net increase of 2.78%, and 2019 would increase by about 2.64%. If you were to look at the growth rate, or the increase in demand, likely increase in demand, you would see clearly that demand growth has slowed down compared to what we showed you in the last opportunity day. And this is because both the IMF and World Bank have both reduced their expectation of world GDP growth rates from 3.9% and 3.8% respectively, to both of them to 3.7% for this year and for next year. But having said that, keep in mind that the rule of thumb that you can see on the right-hand side shows that ton-mile demand would grow at approximately 115 basis points over and above world GDP growth rate. So we're still looking at about a 4.5% type of growth rate. This is a slide that shows you the entire dry bulk fleet and compares it with the amount of ships, or these are the order books compared to the forward order book, compared to what is the percentage of ships that are 20 years or older. Now in this slide, what we've also done for you, we've said that in the next 3 years, we're looking at up to end of 2021 for new buildings. So we should also similarly look at what would be the average age of, or average number, or average percentage of ships that had reached 20 years or greater in the same time frame. So if you do that, then the number goes up to 9.8%, and that's the red dot that you see. Similarly, if you were to look at that same picture, but for the smaller sizes where we are represented, then you would see that for the handy size, the world fleet would have about 16.2% of ships which would be 20 years or older by the end of 2021, whilst the Supras and Ultras would have roughly 10.6% of the world fleet that would be greater than or equal to 20 years of age, whilst the order book for all those years as of today is in the handysize sector roughly half of the older age ships, and in the case of the Ultras is at about 7% compared to the 10.6% in the overage bracket. Coming to trade wars and tariffs, the Republican Party people themselves have been criticizing Trump, and you can see the criticism on this slide. If you look at the various trade organizations, all of them, including the very large Fortune 500 companies, are all represented there, and they're all taking the same stand. They're telling Trump that tariffs don't work. We need to have more trade. If you look at the Hong Kong Bank's research report, it says clearly that emerging markets today are the largest trade beneficiaries or trade partners of China, and it is no longer that China is dependent on America. In fact, the American percentage is just 19% of exports from China. So China is no longer as dependent on America as it used to be. Our own reading of trade sanctions is that if soybeans are not available from America, they'll be available from somewhere else, and that is what has been proved in the first 10 months. Roughly, the amount of soybean imports in China has been the same in the 10 months this year as compared to last year, despite the fact that last year, almost 35 or 40% of the entire imports of China came only from one country, America. And this year, that number has dropped by 95%, and yet China is still importing roughly the same amount of soybeans as last year. So really, trade tariffs don't really stop trade from taking place. If we look at the regulatory changes that are coming up for our industry, then there are lots of them. I will leave this slide for you to read at leisure. It shows you all the different changes that have already taken place and all the new changes that will take place in the future. There are two regulatory changes which are quite prominent and which will come into effect very quickly. One is, of course, the ballast water management plant, which is on the picture which is shown to you on the left-hand side. And then the next right-hand side picture shows you what is the installation like for a abatement technology or something called a scrubber, which will reduce the effluent gas by burning dirty oil of more than 3.5% sulfur down to 0.5% sulfur emissions. This is how the oil changes have taken place, or how cleaner oil has started to be enforced on the industry. So if you go back to the turn of the century, in general, anywhere in the world, you'd be burning 4.5% sulfur oil, all the way to 2012. At the same time, there were special areas known as emission control areas, or ECA areas, where you could only burn 1.5% sulfur oil, even during the time when you could burn 4.5% sulfur oil in the rest of the oceans. Now that came down to 1% in 2010 and has dropped in 2015 to 0.1%. In the meantime, the 4.5% sulfur oil dropped down to 3.5% in 2012, and in 2020 will drop to 0.5%. And if you look at these two lines, you can almost be sure that they'll meet somewhere in the future at 0.1%. So what does this IMO 2020 mean to ship owners? As far as ship owners are concerned, you have got three solutions. The first one is, should you go for scrubbers or exhaust gas cleaning systems? Or secondly, should you switch to low sulfur fuel options, including distillates? or finally, should you switch to LNG fuel? Now, if you do one of these three things, you will see that what owners are actually trying to do. So in these three choices, you can see that on the existing fleet, 413 bulk carriers as of the 5th of November had adopted scrubbers or had planned to adopt scrubbers. If you look at the brand new ships which are there on order, 106 of them will come with scrubbers attached to them. But if you total these two, they're less than 4.3% of the existing world fleet. So not many people going for this option. If you look at LNG fuel, that means you change the engine of the ship and go in for a gas-fired engine, you can see that only 6 ships in the existing fleet have done that. And in the future, another 5 ships would do that. So totally, if you see it's 11 ships, is less than 0.09%. So it's nothing compared to the world fleet. So basically, ship owners are saying that we will burn clean oil. Now, here what I've got for you is the global world fleet, where we are looking at any ship within that fleet which will have its 20th birthday or its 25th birthday or its 30th birthday starting in Q1 next year and ending in Q4 in 2020. Now, in these 8 quarters, almost 40 million tons of ships will have one of these special birthdays, in which case they will have to spend about $1 million to $3 million, depending on the size of the ship, on the special survey. Over and above that, they'll have to fit a ballast water system, which would cost them anywhere between $250,000 and $750,000, depending on the size of the ship. And then finally, on the 1st of January 2020, these old ships would need to burn very clean oil, though the engines are designed for very high sulfur oil, but they'd be forced to burn very low sulfur oil. So this would be a real problem for this age of ships. If we were to analyze the number of ships in terms of percentages and in terms of deadweight tons in the smaller sector where pressure shipping is located, then you would see that there's 15 million tons of ships in that category. So totally there are about 38.5 million tons, and of that about 15 million tons are in the smaller size. Now, if by some miracle all these ships survive and they all by some miracle get a ballast water management system for free and they complete their special surveys, then as of the 1st of January 20, and they don't get scrapped, then as of the 1st of January 2020, there would be approximately 68 million deadweight tons of ships, which would be 20 years or older at the start of IMO 2020. And by the end of the first year of IMO 2020, that number would have gone up by another 10 million tons to about 78 plus million tons. Now, if you're going to burn clean oil, then you're dependent on the oil refineries. And here are all the big players, and each one of them has more or less confirmed that they would be able to supply clean, low sulfur oil at all the ports in their countries and in all the ports that they are represented in today. So it seems that at least the refineries are geared towards low sulfur fuel oil. So what steps can owners take? The first step you take is try to reduce the additional cost of the clean oil. And one method of doing that is to slow down the ship's speed. If you slow down the ship's speed, your consumption of oil will drop. And if it drops enough, then you would save on the extra cost that you would have to pay otherwise for the clean oil. If we assume that every ship in the world was doing 12 knots, every dry bulk ship in the world was doing 12 knots, and we reduced that by 2 knots to 10 knots, then roughly you're saying that 17% of the world's tonnage would not be available at the stroke of a pen. So it seems that once 2020 comes in and all the owners start using clean oil, where the value of is expected to be higher than the cost of dirty oil, people will start to slow down their ships. People will start to scrap the older ships. So one way or the other, you should get a supply side dividend coming in 2020. So what is the strategy that PSL has adopted? We feel that by 2020, rates will start to go up quite sharply. And if they do, then that's the time when we will fix our ships on longer term contracts. This is a snapshot view of the company's assets. You can see clearly that over time we have been slimming down the fleet in terms of numbers. But in terms of deadweight tons, we've remained roughly the same. So now we have currently 36 ships which are approximately 6.25 years of age. The insured value and their market value is roughly the same now. Total deadweight is about 1.5 million deadweight tons, and the average size per ship is about 44,000. This slide shows you the forward book that we have. And if you look at this slide, you can see clearly that the forward book is worth about $150 odd million. And we've got coverage of about 17% of our existing fleet in long-term contracts, where the rate per day per ship is the red line, which you can, the black line, which you can see clearly. The red line is the total days that are there in the 36 ships that we have. And the lowest line, the black line, is the percentage of the red line that has been fixed on long-term contracts at the rate shown in the black line right on the top. If you look at market segmentation, you can see that the handysize sector, as per the Baltic Index, had a time charter rate of 8,254. Against that, PSL had a time charter rate of 10,267, and therefore we outperformed the index by about 24%. If you look at the Supramax index, it had an index level of $11,560 per day per ship. Against that, our ships had a rate of 10,973. So we underperformed the index by about 5%. But just keep in mind, the Supramax ship is based on a 58,000 ton size ship, and our average size for our Supramaxes is around 56,000. In the Ultramax space, there is no real index that they have, but we compare it with the Supramax index, and there we have outperformed the index by almost 20%. So quickly to summarize, 2017 made us know that demand and supply were very, very close by imbalance, and it made more or less every shipping company start to come close to profitability. 18 and 19, we can see clearly that demand is going to grow stronger than supply by about 1 to 2%, and that should be enough for us to maintain and increase profitability. The order book as a ratio compared to the existing older ships is at a point where the forward book is lower than the existing 20-year-old ships in the world fleet. This means that in the forward position, supply growth will be very, very limited. 2020 could be a very interesting year from 2 points of view. One, ships will start to slow down their speed, and therefore supply will be affected by that. And secondly, older ships which cannot handle the low sulfur fuel that is going to be the norm starting on 1st of January 2020 will head towards the scrapyard, and that should also reduce the supply side. Further, environmental rules and regulations are coming up thick and fast. These will prevent people from ordering too many new ships, because the last thing a ship owner wants is a brand new ship on his hands and a new rule and regulation coming in, making the ship more or less obsolete. Cost of funds is going up, interest rates are rising, therefore capital costs will go up, and that will again act as a constraint from ordering too many new ships. There are, however, two areas or red flags that we need to point out. One is geopolitical risks. This is something that is completely outside any ship owner's control, and you've got to watch out for these things. And the second thing is, of course, tariffs being used by Trump. This could act as a speed bump along the road of profitability that we see ahead of us.
So looking at the financials, essentially the third quarter has been very, very similar to the first two quarters of this particular year. And barring that earnings have gone up, there has not been any real change, whether it is in the earnings or in our financial position, except for improvements all along in all of the figures. So if you look at the third quarter, our earnings were exceeded the $11,000 level per day per ship to 11,239. So this is the highest level reached in the last few years. Our ship operating expenses have increased very marginally. This is on account of the fact that, as you will see in the later slides, operating expenses would go up marginally on account of the fact that the ships are getting older and they are now closer to the dry docking dates for our newer ships, which are coming in the next few quarters. Therefore, we had a very good quarter in terms of profitability, $3.25 million, and therefore our margins, gross margin, net profit margins, etc., have all improved. And as we said, we should be improving steadily if things go well. In terms of our financial position, more or less, once again, similar figures in terms of whether you look at cash position, current assets, advances to Senti Shipyard, which are under arbitration, similar position. Fixed assets, we continue to have 36 ships, so this is barring the depreciation effect. There is no change in the fixed asset number. There is one big change in the total long-term loans, because we have repaid some of our long-term loans and we are continuing to repay them, so our total debt is coming down quite significantly, and therefore that is adding to our equity position because of the profitability, and total equity is also increasing, and therefore that, as a consequence of that, our book value is sort of going up. In the last 9 months, it has gone up by 15%. So all around improvements in every respect. Operating expenses, as I said, if you look at the numbers and the breakup of the operating expenses, total operating expenses slightly higher than what they were in the last year on account of the increase in the dry docking and special survey expenses because of the increased age of the fleet, where dry dock expenses start kicking in for the newer ships which were delivered in the last 2, 3, 4 years. If operating expenses are compared with the industry, we now have the 2017 figures available with us. We continue to maintain our outperformance on the operating expenses. We continue to remain approximately $1,000 less than the industry in terms of the total operating expenses. So this, in spite of the fact that the operating expenses, our own operating expenses, show an increasing trend, the level of outperformance remains more or less the same. The next slide is, of course, a graphic representation of the same thing. It shows you the gap between the industry expenses, which is higher by about $1,000 than that of pressure shipping. This slide gives you what it has been right from 1995, so that means about 23 years. As you can see, we had a peak in 1995, then it dropped down to 98, 99. Our TC earnings dropped down, then reached the peak again in 2008, and then after the Lehman crisis and the financial crisis, we reached a low point in the years 2015 and 16, and after which we have been going up in terms of our time charter earnings, And in fact, operating expenses, after reaching a high point in 2009-10, when our ships were oldest ever, around 20 years of age, they have also been dropping as and when we have been getting in the new ships, and the age has also gone down from the peak of 20-21 years in terms of the average age of the fleet, down to about 6 years. And that is reflected in the lower operating expenses in the $4,500 range. And our average size of a ship is, once again, it's the highest it has ever been, of about 44,000 deadweight tons. Debt to equity, once again, reached its peak during the height of the Asian crisis. Thereafter, once again, reached their peak in the 2016-17 period, when we saw the Baltic Dry Index coming down to the lowest ever in its history. And since then, since the last 4 to 6 quarters, this number has been steadily improving, and we are now down to about 1.1 times the equity. So our debt is a very reasonable 1.1 times to equity, and during the course of the next 2-3 years, as profitability increases and cash flows start coming in a larger order, this ratio will also improve further or go down further to right down to in the 0.6, 0.7 levels, which will be, of course, very, very healthy. A similar story for the total debt to EBITDA ratio. Total debt to EBITDA, as you know, it sort of compares the total debt as against the annual cash flow which a company generates. We reached a peak, or you could say a worst position, in the years 2016, 15, 16. And thereafter, this has also come down, not just steadily, it has come down very, very sharply to almost 6 times now. Operating profit, cash operating profit, similar scenario. We had sort of cash losses for the first time ever in the years 2015-16 on an operating level. Never ever did we have that, but obviously that is also a consequence of the lowest ever markets we had ever seen in the history of dry bulk shipping. Thereafter, this has now once again been improving and increasing rather sharply, as you can see, from -5 to now we are to a very high positive 41. So is the case with net profit, cash profit, when you include some of the extraordinary gains or losses. Dividends, we had stopped paying dividends in the last 4 years. Now, as we can see, as profitability improves, the financial strength of the company improves, and we get down our debt to equity to under 1, the company may decide to resume payment of dividends once our balance sheet comes down to very, very sort of almost risk-free levels. Financial profile tells you a similar story. From whatever you have seen, everything, there has been either very sharp improvements or definitely steady improvements. Debt very down, debt equity down, funded debt to equity, net funded debt, if you consider the cash position, down to almost 1. As of now, it's probably, in fact, less than 1. Number of vessels, of course, as we said, we have reduced them by selling or recycling our older ships and bringing in new ships into our fleet, whereby the age of our ships, average of the fleet, has reduced to a level of 6 years from what it used to be in the past. However, this has been done without really reducing the capacity in deadweight terms. So deadweight terms remains at the around the 1.6 million deadweight tons level, which we used to have at our peak position, where we had more ships but similar deadweight tons. Profitability is improved, as you can see. This is the first time we are now profitable as a whole year after 4 years of losses. Awards and achievements, we continue to be conferred with awards on the governance side, on the operations side, in terms of industry, in terms of other financial platforms. So recently we were the finalist for the Ship Owner Operator Awards and the Sea Trade Maritime Awards of 2018, and our wholly owned subsidiary Great Circle Shipping was also the finalist for the Ship Manager of the Year Award. Similarly, sustainability is something which we try and take care of. In the last 1-2 years, we haven't got any awards, but this continues to remain as a area of focus for the company. And so is the case with corporate governance, which continues to remain as an area of focus. We continue to be adjudged or considered as perhaps one of the top 1% of companies in Thailand or even in Asia in terms of corporate governance. So therefore, the latest IOD rankings which has come out has confirmed this, that for the 9th year in a row, we have been adjudged as a company with the excellent level or 5-star level of corporate governance. And even within the companies which are within our sector, we continue to remain in the top quartile of even those outperforming companies. Marine Money, as you know, comes out with a ranking based on the financial listed or publicly available financials of listed companies. This is done for all shipping companies all over the world. We have been, as we saw our dry bulk sector going through the doldrums, we have gone down in our rankings. But now, as you can see, for 2017, our ranking has gone up sharply from what it used to be in 2016 of 62 times or 74, number 74. In 2015, we are now up to 32. And as we see, or as we will see in the course of the next few years, this should go up to even further to 10 or even higher. If you look at just the dry bulk sector, we are now in this 2017, we are ranked number 3 among all the dry bulk sector companies in the world, which is once again a change compared to what it used to be, number 8 in 2015, number 6 in 2015. Now we have even improved on the ranking within the dry bulk sector. So all around improvements, all around very positive changes. We continue to remain, whether we are low on the ranking or high on the ranking, we continue to remain the talk of the town, as perhaps one could say, in terms of the positive view which the industry or the industry specialists or our peers, or whether it is financial institutions or regulators, have about the company. Shareholders' returns, obviously, as you said, considering the lack of dividends in the last 3-4 years, and the market situation have dropped as a consequence of the share price changes also. However, they always remained at very, very healthy levels. So therefore, if one were to compare with what it was, if an investor had invested in the IPO, even at this low level of, or just about when we are at the sort of turn of the recovery position, we are nowhere close to a peak position. even at this level, the investor would have made about 15 times of what he would have invested, she would have invested at the IPO. So this is, by any stretch of your imagination or by any yardstick, a very, very good return which an investor would have got. If the investor had not invested at the IPO, but had done it during the course of the last 15, 20 years at different times, once again, it's all positive today, as of today. Now, depending on wherever he invested, they would have had definitely positive returns. Sometimes, depending on when he had invested, those positive returns would be substantially very high. In some cases, they are not that high. But by and large, as you can see in this particular chart, at all times, at various dates or various periods, whenever the investment was made, it still shows a positive return. With that, we end our presentation, but throw the floor open for questions.
My question is, what key metrics should investors focus on in judging business progress?
So one of the areas that you can look at, of course, is the market segmentation report that we give you, where we show you whether we outperform or underperform the index. So that is one method, because that's the top line. That's the earnings per day per ship. So that's a very key metric. The second metric, of course, is the cost per day per ship. Then again, that's a very key metric, and again, you have to compare that with the industry structure and see whether we are outperforming the industry or not. So these are two very key areas. One brings the revenue in, and one takes the money out of the company. So the gross margin that you get is basically the gap between these two numbers. So again, if you look at those numbers, then over the years, we've been consistently outperforming the benchmarks. So that is one method of looking. The other areas that you look at is, of course, depreciation per day per ship. Third one is interest cost per day per ship. And the fourth one is your management expenses per day per ship. Now, if we look at those numbers, you would also find that in the management expenses per day per day per ship, if you look at it, we are much lower than the industry norm. So again, we don't pay ourselves too much. We have humble headquarters. We've got long-term lease on the property that we are at 1998, 1999 level of lease rents. So again, all areas good. The only two areas where we are now finding that our peers are beating us is, one is in depreciation per day per ship. And why is it that they are suddenly beating us? Till now, we had always been better than them. Now they're suddenly becoming better than us. It is not because we've done something bad and they've done something great. They've basically impaired a lot of their assets. And once they've impaired it, then the depreciation in the forward position falls. And therefore now it seems to us that we are struggling with depreciation at a higher level than our peers. So that's one. The second one is on interest per day per ship. On interest per day per ship, we are roughly 3 times as expensive per day per ship as compared to our peers. And the reason again for that is how we've managed the capital structure of the company. For example, in the last 10 years, if you were to look at the amount of capital raised, equity raised by Precious Shipping, we are at $63 million. And you compare that with any of our peers, they're at a minimum of between 8 and 10 times to a maximum of 20 to 30 times. So basically, if you've taken a lot of money from the shareholder and you make big mistakes also, it's like washing your sins away with lustral water, because you can impair the assets. You have the cash in the balance sheet to do that. Secondly, your interest per day per ship is very low because you're not borrowing money to buy ships. Whilst we do just the opposite. We don't impair assets, so our depreciation now looks slightly higher than others. And we pay a low interest rate on the margin, but since we borrow more than the others because they raise a lot of equity, we don't raise equity, we don't dilute you, as the shareholder of the company. It makes our life difficult, but your life easier. So there are some questions from the net. So I'll just take those in the meantime whilst you guys can think of more questions for us. The first question is, what's the chance of the Thai government adopting IMO 2020 sulfur cap in Thai waters? I personally don't think there is too much of a chance of this getting enacted under the current government because A, they're an interim government, B, they have got an election which is coming up very shortly, and so they're very busy with laws governing those things, getting the new constitution ready, getting all the electoral laws ready, getting all the independent bodies ready. So I think the chances of this happening in this government is very low, but hopefully it will be adopted when the next government is in power. The second question is, please touch on Trump's recent attempt to introduce an experience building phase in IMO 2020. You know, the Americans are very powerful when it comes to the Security Council because they have a veto power. But when it comes to the IMO, they have no such powers. And the IMO basically at their last meeting that they held last month turned around and said, we will not listen to any such ideas of experience building phase, but we are going to enact this legislation exactly on time, on the 1st of January 2020. So though Trump and his government might be very powerful in the Security Council of the United Nations, they have no such powers in the IMO, which is the ruling body for shipping. And they have said clearly that they will not do what Trump's people had made as a statement to the Wall Street Journal.
Most Honorable Management, Mr. Khalid, Most Honorable Mr. Khushro Wadia, I have appreciation, many points of appreciation I have observed, and just speaking to you one by one. Cash cycle, 6.21, now it is 1.94, improved. Congratulations for that. This is showing your working capital management in a very good state. Secondly, we considering you as the low-cost operator, and it is reflecting from the growth rates. Sales growth is higher than cost of goods sold growth. In case of your associate and all the companies taken together, also total revenue growth is higher than total expenses growth. It means you are maintaining the cost reduction and controlling very well and effectively. Another appreciation comes to ROE and ROA. ROA is higher as per the said SMART, but as per your presentation on slide number 44, it is not similar. It may be seen later on, but I admire what has been disclosed by the regulating authority about you. 4.69 is your ROA and ROE is 3.32. I highly admire ROA higher than ROE. Very few companies on SETAs using, and they are showing this ROA higher. It means inbuilt strength. You are utilizing your assets most effectively. Now come to 5-star consecutively, and Mr. Khalid appreciated that 9 years consecutively you are having it. Also very stable outlook, and this is in the upper quartile of those stars. Coming further appreciation on the 3-year performance of adjusted price. Your price now PSL is higher than the transportation sector and SET both. It means the graph is having turnaround over transport sector and SET, also highly admirable. I also admire to you market cap and stockholders equity both are elevating in your company's case. High admiration to the chairman and also to the managing director. They are operating very well. I have one question, and that is effective on current portion of your long-term loan. Thailand is enjoying the lowest cost among 10 countries, first lowest. Can you re-borrow it again to reduce your average cost of borrowing? Just making payment, tax shield you will lose. You can avail that one. And plus current portion will be eliminated if you have lock in the lowest cost of borrowing to the medium to long term, means 5, 10, 15, 20 years by way of revolving loan, perpetual loan or hybrid loan. This is my kind suggestion. Thank you very much. And one appreciation more regarding operating cash flow positive and investing negative. Investing negative, institutional investor consider is a growth company, and operating positive consider as a value company. You are having both good attributes, very attractive. Thank you very much.
Thank you. My question is, if you were sitting down with some potential long-term investors, what 2 or 3 reasons would you give them to invest in the company at this time? Thank you.
I mean, the first reason is that though we've become much more profitable than we were last year, our share price today is roughly where it was last year. So last year, when we were still recovering from losses, our share price was at the same price that it is today. So it's a great entry point. That's one I would give as a reason. 2, if you look at the industry fundamentals, and if you remember the second or the third chart that I showed you, the trend line for the industry looks as if it's headed north. So this is a second point I would emphasize. The third point I would emphasize is the regulatory pressure that is coming in. The regulatory pressure that is coming in on the shipping industry will make sure that the older ships will head to the scrap yards at a much faster speed than they have been doing in this year, and I suspect next year. They will slow down because they're profitable right now, and they will try to slow down the scrapping, but come 2020, they will be forced to scrap at a higher rate. And finally, if you look at Trump and what he tends to do, he tends to bully people and then finally come to a deal. He's the self-confessed deal maker. So there's already talk that he thinks a deal is possible with the Chinese on the trade tariffs when he meets with Xi Jinping on the 30th of November and the 1st of December on the sidelines of the G20 meeting. Again, not too sure whether this will happen or not happen. If it does, then one of the prospects is there that America has been insisting upon, and China has actually been agreeing with America, that they will reduce the gross trade deficit, which is there between China and America, by about $200 to $250 billion. Now, what can China buy from America? They can really buy only 3 things. One is they can buy grain. They've stopped doing that. As I said, soybeans has come down by 95% from America. 2, they can buy coal and pet coke. They can buy these 2 things. 3, they can buy oil and gas. Now, in all these 3 things, America is surplus and doesn't know what to do with these commodities. They really don't have an export home. Now, if you remember the presentation, the main thing that has grown in great significance in China has been twofold. One is the steel production, that's gone up, and 2, coal imports. Now, of the coal imports into China, it's roughly about 300 million tons per year. About 100 million tons comes from Indonesia. Indonesia is roughly 6 days away. Okay? So basically, if I had to transport the same commodity, 100 million tons, from America, then it would take me 7 times the amount of ships to carry the same cargo, because the journey from America to China is 42 days as against the journey from Indonesia to China, which is 6 days. Now, this has not been factored into in anyone's presentations or anyone's expectations, and certainly not in the share price. So, of course, these are all good things waiting to happen. I'm not too sure whether it will happen on this 30th November, 1st December meeting between Xi Jinping and Donald Trump, but it appears quite certain that sometime during next year, it should happen. And there is an industry report by an economist from a Danish bank. It will be there in our next newsletter. This Danish bank economist was the first person to predict in the last quarter of last year that there will be trade war this year and next year. And he's the first one to predict that the trade war will unwind next year. So he was right on the way in. I'm hoping that he's right on the way out. If it is, then it's a great opportunity to invest in shipping company. I hope I've answered your question.
one final question. Thank you. Which of your competitors do you admire and why?
Actually, we are the admirable company. Most of our peers actually admire us. As I said, the main difference between us and any other shipping company, and you can do this research yourself, just go to Bloomberg if you have a Bloomberg screen, and look at what they've done in terms of equity raising in the last 10 years, and also look at the amount of impairments they've taken in the last 10 years. And when you look at those two numbers, you will realize what a safe harbor we have been in terms for our investors. And that makes a big difference. So in terms of admiration, there are certain companies which are truly good companies which one would like to look up to. But if you look at our sector, then we'd be one of those that you'd look up to. Okay, so we have some more questions from the net. They are in Thai, but I'll give you the English version of it. So can our ships use low sulfur oil? Of course they can. They're currently operating in the what is known as the emission control areas, where the sulfur content is only 0.1, which is allowed in the oil, and we do that already. So for us, 0.5 is not a problem. All our ships are very young. The average age is only 6 years. And the next question again in Thai is that come 2020, when most ship owners will slow down their ships, can we as a company, Precious Shipping, can we slow down our assets? And if so, will they have any impact on the asset? And the answer to both is, it is very easy for us to slow down our ships, point one. Point two, we have been operating our ships already at a reasonably slow speed, and all our clients who take our ships on charter or rent out our ships, they all ask us to go as slow as possible. So this is something that is very easy for us to do. We've been doing it for a long time. In terms of impact, no real impact on the ship. Our ships, as I said, are very young, so they can easily stand this type of a stressful environment, which the older ships might find it very difficult to do. Okay, there's another question from the net. It says that why are we seeing a current weakness in the time charter rates? Now, I think this is more a question of the BDI coming down. And I will answer it from that point of view. The BDI coming down has been solely led by the Capesize sector. And this is because China, over the last 2 weeks, has really slowed down the import of iron ore. When you look at the numbers for October and November in iron ore imports, you'll find that there is a sharp drop. That is what has led to the BDI coming down. But it has not significantly impacted in any way the smaller size ships. But it has definitely had an impact on the bigger ships. Okay, Renu, you had a question?
Asking about the OPEC per days that already higher than your target. So you think you will remain the target?
No, I think we will make the target slightly higher. The reason why we had the earlier lower targets was when you have a brand new ship, you have to do a dry dock after 2.5 years, but you can postpone that dry dock to the 5th year. So we initially decided to postpone and just do the dry dock after 5 years, in which case the target could have been met. But what we realized is that when we looked at the ships, we found that the hold condition, that is the insides of the ships, had become quite dirty with the cargoes that we were carrying. And the ship staff really cannot, chip and paint something which is, say, 30 meters high. It's very difficult for them to do that when they're at sea. And therefore, you need to dock the ship to get this done by shore labor and shore equipment. So that's the reason why we had not planned for it. So therefore, the targets were set at a low level, and which we could have easily met. But then we found that by cleaning the ship earlier, you could get more money. The clients were willing to pay more money for that. So it has increased the cost a little bit, not too much, but it has broken our target level. So now we will look at improving the target level, making it slightly higher, because now we realize that we need to dock the ships every 2.5 years. I think they're signaling to us that the time is up, and thank you very much for all your good questions. Sawasdee krap.